Katie, I want to start with you because TCW obviously has a very robust credit offering, both public and private. To you, what does this convergence mean? Is it actually something that's happening, and what does it look like?
Sure. So first of all, Dani, thank you so much for having us here. And I also really want to say to both John and Marc, it's an honor to be with both of you. Diameter and Blue Owl are incredible firms, so honor to be here. And yes, we manage at TCW, global asset manager. We manage about $200 billion. A lot of it is in credit markets, as you said, private and public, regular way private credit, asset-backed finance, CLOs. And then on the public side, we manage across the full spectrum. So to answer your question succinctly, we do believe that there has already started a convergence, and we will continue to have a convergence in credit markets. I would also make the point that I think we're in the very early innings of this trend. Before I had the privilege to lead TCW, I ran a large public equity business at Goldman Sachs Asset Management. And over 20 years, we saw a very large disintermediation of public equity markets. We now have 50% less public companies than we did 20 years ago. And actually, in that market, it's a binary choice generally on the equity side to be public or private, whereas in credit markets, the same company can actually issue public and private. They can lend against cash flows. They can lend against assets. So you have many more options. And so for us, just to conclude, one of the things that we're always trying to do for our clients is be relevant to the borrower. Because if we can be relevant to the borrower across all of those choices, we have more alpha opportunities to capture on behalf of our clients. So we do see this convergence deepening. And we see allocations going up pretty dramatically, in our view, over the next decade. There'll be some vehicles dedicated to those segments, and there are also going to be some vehicles, both for institutions and wealth, that capture both segments.
So you're talking about some of the borrower driving this. John, I'd love to get your point of view, because you have both public and private credit, too, about what is causing a blurring of the lines.
Well, look, I think that borrowers are commercial, and they're reacting to incentives. Historically, where private credit came from was the middle market not being served by the bank syndicated loan market. And so private credit rose up from this idea that middle market companies should have access to loans to be able to do deals. And the success of that built on it and built on it. And I think what you're seeing now is, as private credit succeeded and got into bigger and bigger deals, the line blurs as to what is an obvious private credit deal versus an obvious BSL deal. And it allows, I think, a lot of flexibility for borrowers to figure out what's best for that individual company. And sponsors, company by company, deal by deal, even within the life of the business, the number of times that now the BSL market is taking out the private credit market or vice versa has picked up. And I think that's the idea of providing capital solutions, whether public or private or structured, to borrowers, oftentimes private equity and otherwise, has allowed the entire industry to take off.
Can I press you a bit on that, though? Because you're talking about offering different products to an issuer. Yeah. What does it look like when it's one and the same, when it's hard to distinguish? What does that actually look like?
Well, there's both technical and theoretical differences, I would say, or normative differences. So when you think about a private credit loan, oftentimes there is a higher interest rate on it. Sometimes actually the covenants, most of the time the covenants oftentimes are better. But you're dealing with a smaller group of lenders. You're dealing with, I think most importantly, and this maybe hits the convergence question head on, you're dealing with a different set of norms. And so in the public markets, you are oftentimes dealing with underwriting banks who are then going to syndicate it to many, many, many firms. And you don't really control who owns it. And so your capital structure will look like it will. And so if your debt trades down, it might be hard for you to do M&A because you can't issue debt at par to kind of buy a business that was important to your thesis. But in private credit, if you think of really what the definition of private credit is from a norm perspective, it's that not too many people are in the loan, that you know who is in it, and then most importantly, if something goes wrong, your lenders are going to think about it as a relationship, as a repeat player, and they are going to work with the sponsor in a conciliatory way to deal with the business. And so while on paper it says, oh, I have a floating rate loan, who cares if it comes from Blue Owl or it came from a Goldman Sachs syndicated deal, the norms are actually not convergent. And in fact, they're very, very different in the markets, and it allows the private equity sponsors to choose what's best for each business.
So I definitely want to come back to this point because I think it's a really important one. But Marc, I want to bring you into the conversation because your DNA is private credit. And I wonder what you see as the driving force for this. What is the incentive to have a convergence, a blurring of the line of public and private credit?
So I think it's probably worth trying to unpack even what we mean by the word convergence, in so much as I really loved what Katie and John just had to say, and I think was all spot on. And here's the question: is convergence about this sort of bringing together of a very vibrant public and private market? And to John's point, for example, people are looking at both solutions, and maybe even in some cap structures, there are both. There's public and private pieces. That version of convergence, to me, makes a tremendous amount of sense, and that absolutely is happening. And I think that does favor the organizations like ones here represented, where you can offer a full range of selections between different types of solutions. However, convergence, I think, also is being used by some people to talk about sort of turning private markets into public markets, or I don't know if the reverse even makes sense, public markets into private markets. And I'm less clear on what that, honestly, I'm really less clear on what that means or what problem we're trying to solve. I would say from a private market practitioner, we manage about $250 billion, all focused on the private markets. I don't desire to sort of turn those into public securities. That solution already exists. In fact, we rose, as did many other private providers, private credit or otherwise, to provide a longer-term pool of capital that isn't subject to the vagaries of the daily market. Yeah. And today is a perfect example. If you're a borrower with us, then today you still have steady access to capital. We're not daunted by today's volatility. We're looking forward. But if you're a public borrower, you don't have access today. That's it. 2 days ago you thought you did, and today you probably don't. To me, that is, I don't think, a problem, quote unquote, we want to solve. In fact, we might be creating a problem if we just take the private market and just introduce all that volatility.
Katie, I mean, I want to bring you in this, because if we are entering a more volatile period, what does the macro setup look like for a world where private credit looks a little bit more public, where private credit might be subject to some of the volatility of this market?
I do think we have an interesting macro setup, so I'll comment on that for a second. So, we believe in the business cycle. That doesn't sound like a really brave statement, but we haven't had one for 17 years. That's something for all of you to think about when allocating capital. Everybody up on this stage has been whacked in the face by a business cycle, I think, right? Is that okay? Good. But many people in the industry haven't. I think that's a real thing. We had a short one, but we gave out a lot of free money and we fixed it quickly. So I do think that we are believers in that. We see some softening data. I don't need to rehash it. We all watch Bloomberg, and we know what that is.
I hope so.
But I would say that the valuations haven't yet adjusted for that macro. I believe that to be true in private markets, and here I'm just talking regular way private credit, corporate lending, and I believe it also in public markets. And so how do we navigate? So let me just say one thing on why I think it's what we're watching, and then I'll end with a comment on how we're positioned against that. Just stick on America for a second. We can't really get to a true business cycle until the consumer rolls over, because it's 70% of GDP. The consumer's already in a recession and has been for a while on the very low end of the market, just not the high end of the market. And I think, as many people here know, 50% of consumption in the U.S. is driven by the top 10% of the consumers. So you need to see a crack there to really get the business cycle moving. Employment will be part of that. We have payroll numbers on Friday. We know that there's some weakness in the employment market. It's not very weak yet, but we are seeing layoffs across multiple sectors. So we'll watch that. That's something to watch. I'd also watch equity markets, because this top 10% of the consumer, a lot of their wealth is in houses and in equity markets, and they're transferring that wealth, the baby boomers, to the next generation. So I want to posit to all of you that the transmission mechanism may be a little bit different this time around and come a lot through equity markets. So that's something to watch. I want to end by saying, how are we positioned in this environment? In liquid portfolios, we're running a very large underweight to credit, because against this possibility of a business cycle and some softening, I don't want to over-dramatize it, macro data, we have credit spreads still at record tights versus the last 20 years. And in the private markets, we're deploying capital probably more slowly than our peers. We have strong covenants. We are very disciplined lenders. We say no a lot, and we are at slower rates of deployment than the industry at large. I'll end by saying Where we interestingly do see some opportunity, even in the absence of the business cycle kicking in or a recession, is in rescue finance. So that is where we are deploying record amounts of capital. And that is because interest rates have stayed high because of inflationary pressures. You've got a lot of companies with upside down capital structures. The operating business is okay. The balance sheet is not. And there's an opportunity to go in there, restructure, and ultimately deliver equity-like returns for our clients through the credit.
Honestly, just putting your thoughts and Marc's thoughts together, John, what I kind of almost hear is that this is maybe a horrible time to be an investor if you are seeing a convergence of public and private. If you thought you were getting an illiquidity premium from private markets and things are popping up like trading desks to trade them, or maybe you have to mark to market more, ETFs are coming up, it seems like maybe if you're an investor, if you're an LP, you'd want a clear difference between the two. I mean, is there not some degree where the macro environment that Katie was describing might undo some of this so-called convergence that's happening?
Sure. I think, look, Katie pointed it out well, right? We've seen, more people have seen Bigfoot in the last, decade and a half than a business cycle, most likely. And that means all of us are to some degree asleep. And if you think about the way private markets operate, they don't get marked routinely. And so you could sit around in a private portfolio for a long period of time and think there's no trouble under the surface whatsoever, and have really no incentive to kind of dig for that trouble under the surface. And so one way to maybe think about the convergence is using public, not merging public and private markets, because as Marc said, there's reasons for it and against it. But what you might want to think about is what's going on, what are the public markets telling you that help you underwrite in the private markets, right? So Katie was talking about, hey, spreads are really tight. That might tell me that the market is a little complacent. There's not a lot to earn there. Let me find elsewhere. What I see is there are sectors in the public market where there's a look ahead, where it's saying, hey, maybe the future is not as good as the immediate past. If you think about the way AI is interrupting progress in places or disrupting things, let's look at the software space. A lot of private credit has been in software, partially because software is not cyclical. And private credit was a business that pitched itself saying, hey, we're not going to be in the most cyclical places. But if you look to the public markets, the BSL market, many of the security type of software names have had trouble. Some of those moats were disrupted. Those BSL loans trade down. That, therefore, all of a sudden informs immediately, and in our business, we have public and private in separate funds for separate LPs, but kind of sitting together as a team, saying, wow, that would really change our underwriting of all of maybe SaaS software, or all or partial of it. And so I think that's the best way to think about it. Allow the markets to inform each other, such that you're not just, say, in private credit, not aware of what's going on in the markets, and in public credit, kind of having the back and forth.
So it's almost more like they're talking to each other than becoming one almost.
In our business, that's what's happening. They're not one. But sometimes private credit refinances, sometimes the BSL refinances, but you always have to think about, hey, what's going on in public market spreads? Why is that not being reflected in the fact that I'm being asked to do a very, very tight deal in the private markets and vice versa?
Just adding on that, if we think about the public and private market and this sort of adjacency, our job collectively is to gather all the information and knowledge we can, right? We've looked at 10,000 companies to make the loans that we have. And so there's information value in, just as John said, and as Katie said, in looking at the public markets, looking at the private markets, looking at industries. But I think for me, I come back to this point about the private market's job is to be able to take, and the opportunity, the reason we can earn a premium return for the risk collectively, is to be able to sort of see the signal for the noise, which is to say, today, everything is red. Does that make every company so much worse today than it was yesterday? No, certainly not. Now, you have to pick through it all and figure out what the implications are. But the difference is the sort of, call it almost technical or funds flow nature of movements like today. That's not what our investors want us to respond to. They do want us to respond to fundamental shifts in the world. So when the meta trend, and it's undeniably correct, right, that AI will have dramatic effects in the economy, then they want us to help guide their capital into things like hyperscale data centers. We want to skate to where the puck is going. So I think, to me, it is about looking at the markets holistically. And look, a great economy, the U.S. economy, is one that has really vibrant public and private markets.
So if the convergence happens more forcefully, Marc, is it an unhealthy thing then? If you are forced as a private credit manager to market more frequently because the underlying asset starts to trade more frequently. And you have to incorporate some of the volatility of the market. Is that an unhealthy thing?
We mark all the time. I don't find the marking to be the question. To me, the challenge and the negative of the public market in certain circumstances is accessibility. So it has to do with, is it even available? Think about this, go through COVID or hyperinflationary times or the run of Silicon Valley Bank. It really didn't matter what the particulars of a company were. If you were in the public market, you had no access to incremental capital. If you were in the private market and you still had a fundamentally sound business, you had access from us or others like us. So to me, I look at more the volatility introducing issues of access. We mark all the time. We have BDCs, right? They trade every day. So people know more about the loans that we own than they could possibly know about the loans on a bank balance sheet, for example. Every single loan, you can go through our line items. We rate every single one every single quarter. So it's a bit of an illusion, this idea that there's not transparency in our marketplace, but it is true that we're making decisions that are looking not today, tomorrow, but through to the future.
One fun element of it is there's been nothing more boring in maybe the history of conferences than going to a private credit panel for most of the last decade.
I don't know. They're like hiring celebrities to show up.
Well,
I like them.
No. Partially because everyone's business is similar, right? Mark, like there's been talking about like mega cycles, right? The mega cycle has been the rise of private credit and kind of flanked by firms that have kind of really taken advantage of that. And the reason that the conferences are not as interesting as public market conferences is that, you can have a guy in a public market, I'm long Coke, I'm short Coke, I like Pepsi, right? A total back and forth. Whereas in private credit, it's been a growth of a market that was very, very small, that didn't really exist, and now really maturing and coming into flying with similar business models. And maybe what convergence now can mean is they're going to look a little different. Right? The way we do, so we have a BDC, we have a CLO, we have public and private, but we do it a little differently than they do it at larger firms to my right and my left. And that how those portfolios, how they're going to, all of a sudden, we might sit here in 2 years and it might be a little more interesting on these stages because people's business models, their approach to how often they're trading, their approach to trading, their approach to these norms, how are these norms going to trade are going to be different. And again, at least it'll sell tickets to Bloomberg Invest.
Hey, well, that's if we're not here to do that, then I don't know what we're here for.
It's funny too because everyone's looking for the drama in private markets. Everyone's looking for the drama in private credit, and I don't know if you want to call this good or bad news. It's good news if you're an investor. It might be bad news for the question of seeking drama, which is the private markets by their design have lower amplitude. We and the norms that John talked about. We work with our partner companies to solve problems. It's not, I win, you lose. People are looking for that shoe drop, the big dramatic moment. And I think people are going to be waiting a while to find that moment because it's not the way we operate.
Kate, can I bring you in on this as well? Because also Marc is talking about a bit of a difference of an incentive structure, I think we could call it that. That in private markets, you have an incentive to work with the sponsor, to work with the borrower. Public, not as much. You want to get into the right asset at the right time. If there is a convergence, what happens to that incentive structure? Does something merge with that too? Or are we talking about two different lines of how companies and how issuers and how borrowers work together?
Yeah, and I think that the way that people approach this is going to be, if we do get a business cycle and we do get more differentiation, to your point, not only has the asset class kind of gone up and to the right in terms of growth and launches, we actually haven't had that much differentiation of the credits in most of the environment in which private credit has existed. We have an asset class in private credit that 95% of people haven't invested through a recession, a cycle, or when rates were persistently not zero. So I would just start by saying I don't think we know yet, and we're going to find out. There was a question from the audience here that came up just around like where will you see signs of excess? Like if we are having a business cycle, where are those signs going to get expressed? I think it's going to be different this time because we know that part of the high yield market, which usually we can look to for early signs of stress, has migrated towards private credit, which means that there's going to be possibly some more opacity or delay in those signals. I don't think there's going to be a crisis because I know you've originated well, you've underwritten well, you have all your covenant, you're going to do the right thing for your clients, but there'll just be a little bit of delay in how that signal comes through. And I just want to end by saying you're right that there's more ways and in theory, more tools to work out of a private credit that's gone wrong. I would just say to everybody in this room, defaults haven't yet risen And that is, someone asked the question, where do you look for excess? Generally, you would look for defaults. We haven't had a dramatic rise in defaults, in private credit. There's been defaults in the bank loan market, but in private credit. That doesn't mean there's not stress. It actually may mean that a lot of those people wrote without covenants. They can't come to the table to restructure, and there's amend and pretend. So if someone said, where should we look? Look at extensions. Look at how many amendments are happening to those loans. That is a precursor sign to stress. And I don't think it's a crisis for the whole asset class. I'm a big believer in it. It's going to grow. The demand is there. The supply will continue to be there. It's going to be a great place to be. But there is going to be some testing around this. There are going to be some things that go wrong. And I think looking at people who have given up covenants, who have made optimistic loans, which isn't a great way to make loans, we're going to see some of that come through in this cycle. And that is my answer to where the stress will be. It's not going to express itself the same way it has previously.
Is it worrying then that people are buying private credit ETFs right now, that you have retail investors who maybe don't know the asset class as well in a vehicle that's liquid with underlyings that are less liquid?
Well, there's only one person that's done that, so I'm not going to comment on
fair
that.
Enough.
But I do want to say that going back to, because we're throwing around this term private credit, I want to say that some of these vehicles being offered to individual investors are IG. They're very different than the high yield market, the traditional middle market lending market. And so I want to make that point. And then just final comment, because we haven't talked a lot about origination here. I do think that we've talked a lot about having good covenants, helping you work through a difficult environment. But the story does start with origination. And I think going forward, there's going to be much more scrutiny on behalf of LPs for what are the origination advantages here going forward, and who are you working with on that?
So yeah, the irony is that if you go back to before the financial crisis, there was a convergence in that a lot of people were doing private credit out of hedge funds. And structures that absolutely couldn't. You'd have monthly or quarterly liquidity hedge funds that were making illiquid loans. And that turned into a total disaster, and it exacerbated some of the problems around the financial crisis and liquidity constraints. Today, even in vehicles that may be shown to have done very poor underwriting, the liability structures are pretty good in terms of the ability of people to hold on to the capital, to see the deals through, and the run on the bank element. You saw some of this in the real estate market when some of the kind of retail products for real estate put down gates that were designed to allow people to stay in and work these things through. And so what was one pool of capital doing things has actually come apart. And the question is, how will it come together again? And if you think about excess, to Katie's point, is a cycle will show that not everyone can have the same underwriting standards. So some people will have been bad at underwriting and their portfolios will be bad. But it could also just come from an industry microcycle. If we do still never get to see the Loch Ness Monster and never get our time in the sun for a cycle, it could be that industries. So whether we've seen the microcycles in retail and in energy and in part of healthcare and in banks and in telecom, what's the concentration of risk in private credit vehicles? Do they have 30% in an industry? If that industry is particularly hit, what does that mean? Do they then all of a sudden say, wow, we can't necessarily exit those because it's private. How do we find capital? Do we lose lines from banks? And so I think building on Katie's point, there's definitely excess. It's not obvious where it is. And you don't need a cycle to show it. You might just need industry microcycles to kind of show in particular instances.
I mean, remember, in credit, you either get 100 cents back or something less. That's it. Those are the outcomes. And so it all gets down to origination, underwriting, documentation. And these are the calling cards of a well-run private credit business. Some are well-run. Some we're going to find out are less well-run.
No one here.
Certainly not here. Not if they're smart enough to be at Bloomberg.
Of course.